Hi, I'm David Stein of Money for the Rest of Us, and today I answer the question, what determines home prices and whether they appreciate or depreciate? And we're going to talk about used homes. We don't typically think of used home. We might buy a new home, but when we buy a used home, we just call it a home. Saying it used has some negative connotations. It implies that houses, like used cars, can depreciate or fall in value. And they do. Robert J. Shiller, the Nobel laureate economist and leading housing expert, wrote, "Real home prices should decline with time, except to the extent that households shell out some money and plow back some of their incomes into maintenance and improvement, because homes wear out and go out of style." A real home price is the price after adjusting for inflation. And according to Shiller, for the 100 years ending 1990, before the recent housing boom and bust, U.S. home prices adjusted for inflation on average increased only 0.2% per year. Presumably, if homeowners hadn't put in additional money into the houses for upkeep and improvements, then real home prices would have fallen. But home prices can deviate substantially from their long-term trend and appreciate greater than inflation. Bubbles can form and bubbles can burst. And we've seen that in the U.S. home bubble. According to The Economist magazine, from its base in 1990, U.S. real home prices increased 50% before falling back to earth. Real home prices in Germany are about the same as they were in 1990, but in Japan, which has suffered from deflation over periods of time, real home prices have declined 50% since 1990. Yet there are some countries, such as Australia and Canada, where home prices have increased substantially since 1990 and remain elevated. And so it really depends on the country. And even within a country, such as the U.S., there's some locations, particularly highly desirable areas with high densities, such as along the Southern California coast, much of the value of the home is in the land. And so there's a limited supply of land, beachfront property with majestic views of the ocean and nice weather, and that can keep prices appreciating above inflation as long as the populace values living near the sea. But at some point, global warming could have an impact as the ocean levels rise, and that actually could hurt beachfront property as insurance premiums for flood insurance skyrocket. For most homeowners, though, land represents only a minor portion of a home's cost. And this is data compiled by Morris Davis of the University of Wisconsin and Jonathan Heathcote from the Federal Reserve Bank of Minneapolis. They found the share of U.S. non-farm home value accounted for by land has averaged 32% since 1975. But it can get pricey. So during the housing bubble, land became 48% of a particular home's value, and then it fell to 27% in 2006. So why do home prices appreciate faster than inflation before they eventually peak? In other words, how come we get bubbles that eventually burst? Well, certainly the supply of new homes has an impact on prices, but the real culprit is demand. When interest rates are low, credit readily available, the economy is growing, incomes are rising, and the vast majority of potential buyers believe housing prices will continue to appreciate, they become very exuberant. And there's a fear of missing out, and a bubble is born. But when those conditions reverse, when it's harder to get credit, when people suddenly realize houses could fall in value, then you can have a bust. So how can you tell if there's a housing bubble in your area? By comparing the price of homes to the average household income, and by comparing the annual increase in home prices to the annual increase of rent for a primary residence or an apartment. Consumers have a choice of buying a house or they could rent. And so if the price of homes gets too high relative to income, then they'll rent. And that will lessen demand for houses and eventually impact prices. So for example, since 1982, the median existing home price in the U.S., or the middle value home price in the U.S., is sold for about 3.6 times the median household income. But during the peak of the U.S. housing bubble, homes sold for 4.8 times median household income. So that was a bubble. And at the trough, they sold for about 3.3 times. So right now in May 2017, houses in the U.S. sell for 4.1 times the median household income. But it can vary dramatically depending on which state or city you live in. So you need to go to a realtor and see if you can get the local data. How are houses priced relative to median household income? And is the land constrained? In other words, is there a limited amount of supply coming online because of zoning laws or other geographic issues? And that's what you can look for to figure out if it's a housing bubble or not. Hey, if you like my video, go ahead and subscribe. You can do that by hitting the subscribe button. You'll be notified next time I upload a video. Thanks.